Good day, fellow investors. REITs have definitely crashed over the last year or two, and that is a great time to create an investigation into investing into REITs in 2024. Now, I hope I'm wrong, but if I'm not, this video and the discussions here can help you save a lot of money and especially a lot of trouble in the next decade. We are going to discuss the key factors for investing in REITs, the current situation, Warren Buffett's strategy when it comes to investing, and apply that on REITs, and also 5 REITs. You will also have timestamps in the video so you can jump to whatever is most of your interest. Let's start quickly with the REIT situation. Now, the Vanguard Real Estate Index Fund, it is down 30% over the last 2 years. 30% is a clear crash, and I have had many questions whether now it is a great time to invest in REITs. Remember this date, 23 December 2021 was the peak of the Vanguard Real Estate Index Funds, the peak of REITs, and that is in perfect correlation with the end of zero interest rates. This is the Fed's federal effective rate, end of zero interest rates, and as they were hiking, so REITs went lower, because as you will see now in the investing factors for REITs, everything is first and foremost related to interest rates. It is an interest rate game, as Warren Buffett said. Interest rates work as gravity on the value of assets. And we have discussed the projections interview from Stanley Druckenmiller, who is the best in discussing macro interest rates and everything. And he clearly said in that interview that we summarized in the video that no one can predict interest rates. I have a feeling that most of you sense that interest rates will go down. The news from this week is about a slower economy, worse unemployment, which means that the Fed will lower interest rates. But there are arguments that anything can happen going forward. So we don't know whether interest rates will stay at 5%, go to 8%, or go back to 2%. So it is already a risk entering an interest rate game investment. If Druckenmiller says he doesn't know, who are we to say that we know? If we look at the treasuries, of course, when you got nothing in your bank, a 3% dividend yield was great, but now that you can get 4 or 5% risk-free, 3% isn't good enough. You want 6%, and therefore you have your REIT crash that are down 30%, the Vanguard ETF. The Realty Income chart, for example. Now, if you look at their dividend, everything is good, the dividend is growing, but the dividend yield is now close to 6%, while people were happier with lower interest rates. At a higher stock price, the dividend yield was 4%. This change is just because interest rates went up higher than expected. And now people ask me, Sven, but if interest rates went from 0 to 4%, why didn't the dividend yield go from 4 to 8%? Well, because the market expected here that this will only last for a while and that interest rates will stabilize, I don't know, around 2%. Of course, the market always overshoots, and therefore you have a decline in REITs more than expected. This is because guessing the long-term balance of interest rates is something extremely difficult to do. Impossible, to be fair. But let's discuss interest rates and debt. That is also something that affects REITs from a negative perspective. Now, this is the debt and interest expense from Realty Income, and you can see here that the long-term debt 2 years ago was 15 billion and the cost was just 2%. Just 2 years ahead, the debt, the interest rates on the payment has gone up more than 50%. And that is crucial when it comes to investing, because if this goes to 7%, which is now the possible long-term borrowing rate for REITs, then the payments more than double from here to 1.4 billion just on interest, just on the 20 billion of debt. And what was really funny, Realty Income acquiring Spirit Realty, and they even say that they expect to benefit from Spirit's 4.1 billion of debt. We are still living in a crazy world where if interest rates go up, you are benefiting from 4 billion of debt. Well, that's a novelty, but that is the world people have been living in 20 years, where more debt is better, everything works, and they are still drinking their own Kool-Aid. So attractive capital on that debt with the low interest rates, okay, fixed for some time, but look at this. Already now the estimated market refinance is almost double, and they will enjoy that benefit for a few years. But what happens if rates don't go down tomorrow like everyone is expecting? That would be a huge risk. These are 2 billion in dividend payments, take away 1 billion in higher interest rates, etc. That is half your dividend, and that is a huge hit to the stock. So we haven't seen yet the ugly with REITs because there is still room to crash. So we now, even after a 30% crash with REITs, or 50% for some stocks, or 70% for the riskier, we are still at a medium reward, medium risk situation. Plus, higher interest rates lower real estate values. That's another factor. If you look at valuing a property, it goes with the cap rate. So the current cap rate is around 8%. Some properties were 4%, 5, 6%, but already a different cap rate going from 6 to 8%, that implies a decline in the value of the property of 20-25% when you are buying something. And that's also something impacting REITs, because REITs have been the best investment out there in the last 20 years, 11% returns on average over the 2 decades there. But also cap rates went from 11% to 6%, so halved, which means that all the assets, the value of the real estate doubled there, and there you have your return. Plus, people were really investing in properties at an 11% yield, therefore they enjoyed a 11% return. Now, over the last decade, people have been investing at 6%, and if cap rates go up, they will lose this 6%. That was the benefit of real estate prices going up. Here, real estate prices going down, that is then a big double negative. Apart from interest rates, there is also the debt issue with REITs. Interest rates push up, lower rates push up real estate prices, and REITs acquire a lot of things at higher prices because of lower interest rates. But look at this. What happens if real estate prices crash? Like we have seen a crash. Look at this. Booming and then going back to normal. Booming. That is the huge risk that few discuss when it comes to investing in REITs. Reality, maybe not that far, but this would already send many REITs to bankruptcy and say goodbye to your investment returns if this happens. Of course, those are potential risks. I hope those don't materialize, but it's also something that we have to manage. And there is one certainty. Most REITs bought their real estate at top prices and took debt. That debt is not going anywhere. The cost is going higher, but if the real estate prices go lower, well, if you haven't seen the Big Short movie that we'll discuss further, watch it. Then with REITs, the third key factor is quality of assets. The best REIT out there, Prologis, investing in logistics, very high price, dividend yield of 3%. 2 years ago, people were extremely in love with the logistics that will change the world. Everything is all about logistics. There was a boom and they were happy with the 2% dividend yield. Now they still like it, but now it's a 3% dividend yield. Still very, very low because the quality is there and people are happy owning it for a low dividend yield. So with REITs, higher quality, lower dividend yield, lower quality, higher dividend yield. Risk and reward, academic here, that's how it looks like. Now, on risk and yield further, this is the Geo Group, the Prison REIT, and you can see here how there was a 5%, 6% dividend yield, then things started going ugly. People were expecting that this constant growth was not sustainable, they cut their dividend, but at the peak of that, the dividend yield was 22.5%. Of course, not sustainable, but when they cut it, what happened to the stock? It's down 70% from the peak. So when this happens, it is very, very ugly. Then we also have a situation where a low yield, this was 2.5% just 2 years ago, Alexandria Real Estate, we'll discuss it more, but people loved it because of the perceived quality that maybe wasn't there, and now we have a 50% crash. So with yields, it's always interesting. You need to know your REIT, why you bought it, and why you need it. Pension funds were buying because they had no other option and they don't care about long-term investing. That we will also discuss in a moment. The fifth factor is that if you own real estate, you should be protected from inflation. That's correct, but inflation already happened and already gave you that protection. If we look at the chart, this is inflation. This is money printing at its best. So REITs already enjoyed the boom in real estate prices, and that is inflation. And the thing is that rent increases are slow, are sluggish, have to be negotiated. Inflation is there and it isn't as linear as one might think. Plus also, as we have higher interest rates, that costs go higher and that is not compensated immediately by potential rent increases. So, I've given you the factors. This is now my opinion on investing in REITs. First, if you look at the cap rate now, it is around 8% for investing in properties. This is from Realty Income. Well, if the dividend there is 6% or even lower, why don't I invest myself into real estate at 8%? Why do I need to give 25% or more of my yield on that property to a REIT management? That's something that I don't get. Plus, this is without leverage. With leverage, the yield should be even higher, and therefore I could make more money if I can manage my own leverage. But that's just one thing. The key when it comes to investing in real estate, I think, is that there are good and bad times to invest in real estate. A few times over one's lifetime, there are great times to invest in real estate. You do that and you are settled for life. Investing now, maybe we are at medium times, but not certainly at great times. If we look again at commercial prices here, is it now a good or bad time to invest in real estate? Or the early 2010s, the 1990s, the 1970s when Schwarzenegger was buying his properties that made him rich and allowed him to study acting and later made even more money, when it is a better time to buy properties? Now, at peak, when everyone is buying, or when no one is buying? And if you look at Prologis, even the great REIT there, look at their buys during cheap real estate prices, and look at how their buying, acquisition of real estate increases as prices go up. 2007, 2008, crazy buying. Also, of course, the stock crashes, and when everything is cheap, nobody is buying. That's exactly the time you need to buy real estate. I would summarize the current REIT investing with this snapshot from The Big Short, with the stripper, of course. Your monthlies could go up 300% on higher interest rates, real estate prices don't go up anymore, and that is an ugly, ugly situation. I think that we are seeing this now, maybe for different reasons than in 2007, but we haven't seen this yet. This is the main risk, and we'll discuss that more now with Buffett's investing. This has happened, of course. It can jump higher immediately, but it can also go lower, stay lower, because I don't think that this can be printed out of issues. So that is a risk that you're taking if you're investing in REITs, even if REITs look great now. And that leads me to Warren Buffett. And he is not investing in REITs. He tried a REIT a while ago, sold it immediately, and didn't even wait for the takeover. But let me explain his thinking here, and it might save you a lot of money over time. So Buffett doesn't invest in REITs because he has a little bit more experience than we have, and Charlie Munger has even more experience. He made his fortune in real estate, so they know more than we do. And then again, real estate prices, don't invest in bubbles. The returns there have already been made in the first 2 decades of this century. And again, if we think about it, there are only a few opportunities in our lifetime. Is it now the right time to invest in REITs when everyone is investing in real estate, plenty of money, bubble just around the corner? We just have seen a 30% crash, but we haven't seen the pain. Let me show the pain. Buffett's 2013 letter to shareholders discussing investing in REITs. Ben Graham quote, okay, but the tale begins in Nebraska. So the Midwest experienced an explosion in farm prices alongside inflation. That's what we experienced already. So runaway inflation. But eventually the bubble burst, bringing price declines of 50% or more that devastated both leveraged farmers and their lenders. 5 times as many Iowa and Nebraska banks failed in that bubble aftermath than in our recent Great Recession. This pain is something that we are not yet seeing, but that pain is the time when Warren Buffett purchased a 400-acre farm for some little money, no knowledge about farming, but then he got 10% from it, everything went up, and he considers it a good investment. And these kinds of investments are the investments we need to make as real estate investors when the opportunity is there. But you must always know, there would of course be the occasional bad crop and prices would sometimes disappoint, but so what? There would be some usually good years as well, and I would never be under any pressure to sell the property. We'll see later with Vonovia, they are under pressure to sell the property, and that's again one no in risks because you are under the control of banks. Another investment, New York retail property adjacent to New York University. So the current unleveraged yield from the property was 10%, undermanaged, so increases in rent potential, okay. Annual distributions now exceed 35% of our original equity, plus they already took up 150% of what they had invested. But they invested in 1993, which was a great time to invest. The situation is that when you invest in real estate, you're looking for solid and satisfactory holdings for lifetime and subsequently for children and grandchildren. If you can find that, do that, but I don't think you can find that with REITs. Because REITs promise quick profits, leveraged profits, rebounds, constant growth, and they are not considering the productivity of the asset because they are buying more and more when prices go up. And they do that because most investors are focused on prices going up, and prices go up if you grow. Everyone is a speculator, and if you think only about what the properties would produce, that's how to invest in REITs. And you can forget about macro opinions, interest rates, because that is a waste of time. Nobody can predict that. That is Warren Buffett's style of investing. Are we now in an environment that justifies investing like Warren Buffett? Can you invest at 10% yields, refinance later when things are better? No, because there is still so much competition there, and therefore also think of the REITs. They invested huge amounts of money in the past, and they are still rushing to invest. High competition, high prices, high interest rates. Maybe it's still time to wait for really ugly times, banks going bankrupt on those, REITs going bankrupt, etc. So there is still time. Now let's discuss a few REITs. Realty Income, a bit down, but as you can see, it did great over the last 2 decades. It is already doing good, very good over the last month, because people are expecting that the Fed will bring rates lower, which is then a positive. But the company is still there, paying a good dividend, everything looks good. Not stellar growth, but this is REIT stability. And here you come to what I don't really like. They have grown issuing huge amounts of equity over time, which means the equity is expensive when you issue that much, significant amounts of debt to grow, more debt during the acquisition, and they are still spending as much as they can to acquire, buy, and play the game until they can't play it anymore. They're even specialists in European portfolio. They invest, borrow, really do great things. 9 billion acquisition at the peak of commercial real estate prices. But of course, the Great Recession superstars rate everything with great numbers, so stability there. Nobody cares about the debt. But if interest rates stabilize higher, this interest expense would be very, very high, as we already discussed. It could cut the dividend, and then you can find yourself in a bad situation for 5 to 10 years. And also on those cap rates, now at 7.8%, but they are borrowing at 7%, so not really stellar for them. But this is their story. I would say that the most likely outlook is no growth there, and then you end up with a 4 or 5% return over the long term. If they need to cut the dividend, then you have a big crash. The ugly, we haven't seen yet when it's best to buy. So medium risk, medium reward, not a great buy. I would leave it to pension funds, and that's it. As I said, focus on real estate on your own. Now, a very interesting suggestion by Georgie on my research platform, Alexandria. It is down 56%. It invests in medical laboratories, etc. Very, very sexy. They want to make clusters, DNA, etc. Boston, Fenway, MIT, whatever. They did really well, of course, since 2013. Somehow no REIT talks about 2009, 2013. Good collections, good occupancy, that's standard with REITs, 95, 93%. Good dividend yield, growth over the last 5 years, of course. Good cash flows, nothing wrong. But then again, a lot of debt issuance, a lot of equity issues. And again, we have seen this from the Cathy Wood Laboratories boom, but it can get really ugly, and they didn't make acquisitions here. So I think that the most likely outcome, it will be ups and downs. You can make 20-30% for a while. It's flat forward. So see how it comes to owning this. Another REIT, Allied Properties, and there is always something to learn. This is already a 70% decline in values, Canadian REIT. And if you look at their portfolio, 12 billion, huge growth, they really grew. You would say, wow, that's a growth story. But the dividend didn't grow as much. This is just 50% growth because, of course, they were issuing a lot of equity. They had properties, potential, everything. But look at this. The net debt multiple of adjusted EBITDA is 10 times. The average of REITs is 5 times, which in my opinion is already high, but they say for them that that is low leverage. So this is really crazy. And I looked further a little bit, and then you say, okay, they have 12 billion in assets and just 3.5 billion in debt. Yes, but if I look at their operating income, I apply a 7% cap rate, then the value of those real estate is not 12 billion, it's 4 billion. Compare it to the debt level, the equity is 0, and that is the risk there. So calculate your own values, not what the REIT managers are telling you. Now, this one looks good. Another Canadian saying hi to my fellow Canadians. I'm not discussing Canada often as you request because you're living in good times. You don't want me talking about your stocks, because that means that the economy is ugly, that the market is ugly, and that you are suffering in pain. That's why I don't talk about you, my fellow friends, Canadians. But if I start talking about you, then there will be opportunities, but your life won't be as good as you have it now. You just had a property bubble that is steaming a little bit, slowing down. But this is now smart centers. It is something that I like. It's a good one. If I had to buy some REITs, I would buy this one. They have their properties across Canada. Walmart is their greatest tenant. They are developing, they want to build apartments on the top of Walmarts. They call it an intensification opportunity. So from shopping centers to city centers, they have a lot of assets. They plan to invest 16 billion to develop these city centers on top of the existing Walmarts. They have this potential there. They have a lot of asset value. So they didn't issue equity like other REITs, which is something very interesting. Good cash distributions. Not that much debt compared to the assets, so unencumbered assets, 8 billion, nothing wrong. Of course, we're talking about Canadian dollars here. Real estate assets, 12 billion, 4.5 billion in debt. Okay, that can be balanced, and even if interest rates double, the interest expense should go up then to 200 million. Okay, lower 100 million from dividends. That could be a dividend cut in a worst case scenario. The stock would go lower, but that might be a time to buy. Now, it looks good, but that doesn't mean that the stock will just go up. It can happen that you have 10 years of nothing, but that is investing in real estate. Remember Warren Buffett. He invested for the yield, not for the stock going up. And we are now, as said, mid, not ugly. When you're investing in ugly, things are good. No, low risk, high reward. Now we are medium risk, medium reward. So it's good to watch something like this if you are looking to give something to your grandchildren, but then you have to or buy now, and then if it goes lower, be ready to buy more, which is also a strategy, or again, wait for better, more opportunistic investing. A REIT that's already bankrupt. So a suggestion on my research platform, just to check a small REIT, market cap 25 billion, down already, I think 75%. Just look at these numbers. Total assets, $500 million, long-term debt, with interest rates going up, the value of the assets go down, and the equity is quickly erased, and that's why you see the stock price going to zero and likely going bankrupt if no one takes them over. Vonovia, yes, it has the potential to 2x, but I was looking at this and this made me laugh. The investor bought in March made already 50%. The investor that bought in February is still down 9%. This is what happens with these restructuring things. You are betting on things jumping, and I have no idea where will Vonovia go. Of course, you can bet, as I said, it can go 2x, but they are selling properties, and therefore the stock price going up and down will depend on the price they get on their properties. They are already selling below book value. If they put more on the market, it might go even lower. It is an interest rate game. And yes, the rents are stable, people are paying their rent in Germany, but depends also on the value of real estate. They took huge debt levels. The banks are already looking how they can get their value there, and therefore it is simple real estate betting. If you're not a lawyer, if you don't know how to deal with these things, I would not suggest it for retail investors, despite the 2x potential. It can also be 5 years of ugly, like those that invested earlier are already seeing, despite the 50% up. So medium risk, medium reward. I think I shared a lot of value here to understand better investing in real estate. In my opinion, one should wait for the great opportunity that might come in 10 years. There was certainly here 5-6 years ago, in some markets even 2-3 years ago, with zero interest rates. I was always yelling on this channel, take a fixed 30-year mortgage with 0, 1, 2, 3 interest rate and enjoy life. Many of you did that, so I'm happy for you. For the others, wait for better times. Thanks for watching. I'll see you in the next video.